Hello, everyone, and welcome back to Synaptic Investing. I hope you're having a fantastic week and are ready for another deep dive. Today, we're breaking down one of the titans of the energy world, ExxonMobil Corporation. On the surface, it's this enduring energy machine, a cornerstone for, well, over a century. But the real question for us as long-term investors is this. Does it truly qualify as a wonderful company that can navigate the massive shifts ahead? Are there hidden strengths or maybe vulnerabilities the market is missing? That's what we're here to find out.
That's a massive question. And before we get into the details, just a quick note for everyone watching.
For those who want to act on these investing ideas, having a professional-grade platform is key. We use Interactive Brokers, and we've partnered with them to get our viewers a stock bonus when they sign up.
So they get a bonus and support the channel at the same time. That link is in the description, right?
That's right. And of course, if you find value in this kind of in-depth discussion, the best way to let us know and to get the next one is to subscribe and like the video. It truly helps the channel. And if you have any questions regarding the company, please manifest yourself in the comments section.
Perfect. Now let's get into it. Pillar number 1, the business model. Understanding ExxonMobil's business, it's really quite the machine.
Yeah, exactly. The enduring energy machine. When most people hear ExxonMobil, the mind jumps straight to oil rigs, maybe gas stations.
Yeah, the classic super major image.
Right, drilling for oil all over the globe.
Yeah.
But I think what's often missed, and maybe what's crucial here, is that this company it's way more than just drilling. It's this incredibly complex, integrated system.
It really is. Designed to manage molecules at a massive, almost unbelievable global scale.
And that reorganization they did back in 2022 seems really key to understanding them now.
Oh, absolutely pivotal. It wasn't just, shuffling boxes on an org chart. It was a fundamental shift.
How so?
Well, they moved from being mainly process-oriented, grouping things by what they did, like refining here, chemicals there, to being purpose-oriented.
Purpose-oriented.
Yeah. So now it's streamlined into 3 core businesses, all facing the market directly. Upstream, product solutions, and the newer one, low-carbon solutions.
Okay. Upstream, product solutions, low-carbon solutions.
Exactly. And this shift is, well, it's deeply significant. It lets management apply different KPIs, different capital hurdles, different time horizons even to each segment.
Ah, so they can optimize each part for its specific role.
Precisely. Optimizes the whole company for, the challenges of today and tomorrow, brings strategic clarity, helps them really maximize value from the wellhead all the way to the final product.
Okay, that reorganization, the 3 segments, sounds powerful on paper. But for our listeners, how does this new structure actually make money? Where's the value really generated?
Right. Let's break it down. First, upstream. This is, without a doubt, the bedrock. It's the profit engine for the whole company.
This is the oil and gas exploration and production part.
Correct. Finding it, getting it out of the ground. And their reach is incredible operations in, 40 countries.
Wow.
Yeah, a huge, diverse portfolio. Deep water, shale, LNG, conventional stuff. It's all in there. And that diversity isn't just, for show. It provides resilience.
Flexibility.
And the margins must be good here.
Extremely good. Consider this. Fiscal year 23, Upstream generated 57% over half of the company's total earnings.
57%.
Yeah. And get this. It did that from only 7.4% of the total sales and operating revenue.
Okay, that really tells the story. High margin is an understatement.
Right. It just underscores how profitable this part of the business is. Its strategic purpose is crystal clear, too. Generate maximum free cash flow from the best, lowest-cost resources they can find globally, and do that for decades. This cash flow funds everything else: shareholder returns, growth, the other segments.
Okay, so upstream pulls the raw stuff out. Then it has to go somewhere, meet the economy. That's where product solutions comes in, right? Exactly. And this is where it gets, I think, really compelling, because this combines what used to be their downstream and chemicals businesses.
So refining and chemicals together.
Yep. Makes them the world's largest integrated downstream and chemical company, full stop.
That's huge.
It is. And this segment takes those raw hydrocarbons from upstream and turns them into things we all use every day.
Like gasoline, diesel, jet fuel.
Right, the fuels that power everything. And also high-performance stuff like Mobil 1 lubricants. That's a globally recognized brand, a leader.
Mobil 1, yeah, everyone knows that one.
And it's not just fuels, The scope goes way beyond that. Think about the basic petrochemicals they make.
Like what?
Olefins, aromatics, polyethylene, polypropylene. These complex chemicals are the building blocks.
Building blocks for
countless things. Plastics and packaging, medical supplies, car parts to make vehicles lighter, textiles, You name it.
So this segment is the big revenue generator.
Oh, by far. The energy products part alone brought in something like 77% of total company revenue in 2023. It's the heavyweight.
And there's another angle here too, isn't there? About smoothing things out.
Yes, a crucial point, often overlooked. Product solutions acts like a natural shock absorber for the company.
How does that work?
Well, think about when crude oil prices fluctuate, especially when they drop.
Right.
The input costs for product solutions, the crude oil itself, go down. This often means their refining and chemical margins actually expand.
So lower oil prices hurt upstream but can actually help product solutions.
Exactly. It helps smooth out the overall company earnings through those inevitable commodity cycles. It's a strategic hedge, kind of built right into the business model.
That's clever, a natural counterbalance.
Precisely. Then we get to the third segment, low-carbon solutions. This is the newest piece and arguably the most focused on the future strategy.
Right, the LCS business.
And connecting this to the bigger picture, it's really vital to understand this isn't just, a greenwashing effort or a PR exercise.
It's not just for show.
No, it's being built with the clear goal of becoming a large-scale, profitable business in its own right. Notice what they're not doing. They're not chasing, say, building wind farms or vast solar arrays.
Why not? Some of their peers are heavily into renewables.
Because they've looked at it and decided they don't have a distinct competitive edge there. They don't see a path to generating the kind of above-average returns investors expect from ExxonMobil in those spaces.
So instead,
they're focusing on complex, molecule-based solutions, things that play directly to their historical strengths.
strengths like
Managing massive, capital-intensive chemical processes, understanding subsurface geology, things they've been doing for 100 years.
Okay, so what specific areas are we talking about within LCS? Molecule-based solutions, like what?
We're talking about carbon capture and storage,
Oh, yeah.
CCS. That uses their deep knowledge of geology, understanding rock formations for storage.
Wait, underground storage? Makes sense.
Then there's hydrogen production, blue hydrogen specifically, which again leverages their chemical engineering skills. They're also working on lower emission fuels, like biofuels.
Biofuels too.
Yep. And one detail that's particularly interesting is their move into lithium production.
Lithium, like for batteries.
Exactly. But they're looking at extracting it from brine saltwater found underground, and that directly uses their subsurface know-how, drilling, fluid processing, the same skills honed in oil and gas.
So it's not a random leap. It's extending their core skills into a new, related area.
Precisely. A logical extension, not jumping into something completely unknown.
So these three segments, upstream, product solutions, low-carbon solutions, they work together.
They do. And the combined power creates what some have called the Lollapalooza effect.
The Lollapalooza effect? I like that. Explain that.
It's where you have multiple powerful forces, all combining, all acting in the same direction. The result isn't just additive, it's multiplicative, an overwhelmingly potent outcome.
Okay. And for ExxonMobil, what are those forces?
Well, we can identify at least 4 key ones contributing to this synergy. First, just immense scale.
Their sheer size.
Right. Their global presence creates huge advantages. Think purchasing power. They negotiate better deals on everything than smaller players. Think logistics, moving millions of barrels, tons of chemicals daily, super efficiently.
And R&D.
Crucially, R&D. That scale allows them to fund a world-class research organization. That's a luxury smaller companies just don't have. They can experiment, innovate, make those long-term bets.
Okay, scale is one. What's next?
Second, building on that, is deep technological leadership. ExxonMobil is fundamentally a technology company.
More than just an oil company.
Absolutely. Their history is packed with innovation. They pioneered 3D seismic imaging that revolutionized finding oil. They developed proprietary catalysts for their chemical plants to boost efficiency, create better products.
And the patents reflect that.
Over 8,000 active patents worldwide. This deep well of proprietary tech gives them a durable edge. Finding resources cheaper, making products better, creating materials that command premium prices. It's decades of relentless investment paying off.
Scale, technology.
Third, operational excellence. This is deeply baked into their culture. It's engineering-driven, relentlessly focused on safety, reliability, cost control across everything they do globally.
That sounds like a competitive advantage in itself.
It absolutely is.
Yeah.
Minimizing expensive downtime, running assets hard but safely, managing incredibly complex, potentially hazardous operations with discipline. It's about doing things right, consistently at a massive scale. Few companies can truly match that.
Okay. Scale, tech, operations, the fourth factor.
The fourth is the power of integration, the synergy, the linkage between all those segments we talked about.
They fit together.
Exactly. It's a self-reinforcing system. Upstream provides low-cost raw materials to product solutions. Product solutions provides a stable outlet for those materials and, as we said, acts as that hedge against price swings.
Okay.
And here's the kicker. The huge, reliable cash flows generated by this whole integrated machine, that's what funds the big growth projects, the R&D that keeps the tech edge sharp, the new low-carbon solutions business.
And shareholder returns, too, presumably.
And, crucially, yes, consistent, large-scale returns of capital to shareholders. Dividends, buybacks, it's a virtuous cycle building on itself year after year.
So when you combine scale, tech, operations, integration, that's the Lollapalooza effect.
That's it. It creates this corporate fortress. Resilience, cash generation, far greater than just adding up the parts. This is what lets them invest through cycles, plan for decades ahead. Many competitors just don't have that luxury.
So stepping back from the corporate structure and the synergies, what does this all mean for, the person on the street? What is ExxonMobil actually selling us when you boil it all down?
That's a fundamental question, and the answer is their products are not discretionary. They're not luxuries you can choose to skip.
Energy isn't optional.
Energy is the master resource. It underpins literally all economic activity. Agriculture, manufacturing, transport, the digital world we live in. It all runs on energy.
And the petrochemicals.
They're not just commodities either. They are the essential building blocks for critical goods. Medical devices, fertilizers for food, lighter car parts for efficiency, advanced fabrics, safe food packaging. Modern life depends on these materials.
So it ties into that investment principle. Businesses satisfying basic, enduring human needs.
Exactly. The specific form of energy might evolve, no doubt, but the underlying demand for energy itself and for advanced materials is permanent. It's growing, especially in the developing world.
So the question isn't if we'll need energy and material.
Right. The critical question for a long-term investor is who is best positioned to supply them. Reliably, affordably, and importantly, in their evolving lower emission forms as the transition happens. ExxonMobil's entire strategy is built around being the answer to that question.
Okay, let's pivot to the moat. Every great company needs that sustainable competitive advantage. You're suggesting ExxonMobil has a wide, durable one, and maybe it's even getting wider. How can that be in such a changing industry?
Well, the deepest part of that moat, the foundation really, is their cost advantage.
Lower cost than competitors.
Significantly lower. And it comes from two things. That immense scale we talked about and how they strategically manage their assets.
Let's break that down. Scale first.
On scale, they've achieved staggering cost savings. Since 2019, $9.7 billion in cumulative structural cost savings.
Structural meaning permanent.
Yes, not just temporary cuts. Permanent reductions in how they operate. And they're aiming for $15 billion in annual savings by 2027. This directly lowers their break-even cost across the board, widening that margin advantage. They can make money when others are losing it.
Okay, that's the scale part. What about the assets? You mentioned strategic management.
This is maybe the most critical piece, their advantaged assets. It's about their deliberate strategy of high-grading the portfolio.
High-grading, meaning?
Selling off older, less profitable assets and focusing investment intensely on their very best, lowest cost of supply resources around the world. This is key to their long-term viability.
Like Guyana. That's been huge news.
Exactly. Guyana, the Stabroek Block offshore, it's a generational discovery. The estimated break-even oil price there is near $35 a barrel.
$35.
Yeah. That puts it in the lowest 10th percentile globally. Those barrels are incredibly profitable even if oil prices slump.
Wow. And the Permian, the Pioneer acquisition.
Another perfect example. That wasn't just about buying volume. It was a strategic move to transform how shale is developed.
Transform it how?
Well, traditionally, shale's been short cycle. Drill fast, high decline rates, constant reinvestment needed.
Right.
But by combining Pioneer's massive connected acreage with ExxonMobil's big project expertise, their infrastructure, their technology, they're turning the Permian into something different.
Different how?
More like a long-duration, low-cost manufacturing operation. They can plan development systematically for decades, optimize water, gas processing, everything. Drive down unit costs to levels smaller players just can't match.
So it becomes a long-term, predictable resource base, not just short-term drilling.
Precisely. And by 2030, they expect over 60% of their total production will come from these advantaged assets, Guyana, Permian, Brazil, their LNG projects. That creates a structural margin advantage that should be incredibly durable.
Good. Cost advantages are huge.
Yeah.
What about intangible assets? Things you can't touch but add value.
Absolutely critical, too. Their proprietary technology and expertise are formidable. We mentioned the 8,000 patents, seismic imaging, reservoir modeling, chemical catalysts.
Right.
This deep institutional knowledge gives them a real technological edge. It lets them find and develop resources cheaper, get more high-value products out of each barrel, create unique materials. It's almost impossible to replicate from scratch.
And brand equity. You mentioned Mobil 1 again. Does a brand really matter for a giant industrial company like this?
It does, maybe more than people think. Mobil 1 is the undisputed global leader in synthetic motor oil. Premium product, huge trust from consumers, mechanics, car makers.
So that means higher prices, better margins.
Exactly. In the lubricants business, which is a solid, stable profit contributor, and don't forget their Exxon and Mobil fuel stations too, that's a direct, trusted connection to millions of customers. It's not just a logo. It's decades of built-up trust.
Okay. Then there's this idea of efficient scale. Barriers to entry.
Yeah, this is a powerful concept. Think about the sheer amount of capital needed, the specialized technical skills, the operational complexity to build what ExxonMobil has built.
A global network of assets.
Upstream fields, pipelines, supertankers, refineries, chemical plants, hundreds of billions of dollars, decades of work. Trying to replicate that today, it's almost unimaginable. You'd need, I don't know, several sovereign wealth funds and a time machine.
So it effectively locks out new competitors at that scale.
Pretty much. It ensures the industry stays dominated by a few large, established players.
Yeah.
Protects their position.
Now, I found it fascinating how they seem to apply Buffett's circle of competence idea, especially to their energy transition strategy. It explains why they're maybe not jumping into renewables like some others.
It's a brilliant lens, isn't it? A real masterclass in discipline, I think. CEO Darren Woods is very clear. Their core competence is managing molecules at scale.
Managing molecules.
Across complex, capital-intensive value chains. That's what they do best. So they are deliberately, explicitly avoiding areas like building wind farms or solar plants.
Because it's outside that circle.
Exactly. They've said they don't see how they can generate above-average returns for investors there. It's hyper-competitive, and it's not where their unique advantages lie. They're sticking to their knitting, basically.
So the low-carbon solution strategy, CCS, hydrogen that is inside the circle.
Yes, it's a direct, logical expansion. It leverages skills they already have in abundance: geology, reservoir management, chemical engineering. It's not diversification for its own sake. It's about taking existing strengths into new, adjacent, and potentially very profitable markets.
And this disciplined approach, how does that help the moat last?
It's critical for durability. Think about a future where oil demand declines. Who gets shut down first?
The highest cost producers.
Right. By focusing relentlessly on the lowest cost assets Guyana, Permian ExxonMobil's barrels will be among the very last ones produced. They can actually gain market share and capture most of the profits as the industry consolidates.
And LCS helps transfer the moat.
Exactly. It helps transfer their competitive advantages from the old energy system to the new one. Building the infrastructure for carbon management, for hydrogen, ensures their relevance and profitability far into the future, building on what they already do well.
Okay, let's zoom out now to the industry itself. The whole energy transition narrative is powerful. It's everywhere. But the reality seems, well, more nuanced, maybe slower.
Indeed. It's definitely not smart to bet the farm on just one single forecast. You really need to look at a range of credible scenarios from serious organizations to get a feel for the possibilities.
Like who?
Well, take the EIA, the U.S. Energy Information Administration. Their reference case project's global energy consumption keeps rising through 2050.
Keeps rising, even with renewables.
Yeah. And crucially, oil and natural gas demand also keep rising in their view. Driven by population growth, rising living standards in developing countries, renewables meet the new demand growth, but they don't necessarily displace the huge existing fossil fuel base quickly.
Okay, that's one view. What about the IEA, the International Energy Agency? They often seem more aggressive on the transition.
They do. If you look at their IEA STEP scenario, that's the stated policies scenario, it projects a peak for all fossil fuels sometime before 2030.
A peak soon then.
Yes, but, and this is the crucial detail, it's a gradual decline after that peak. Not a collapse, not falling off a cliff. The world, even in that scenario, is still consuming tens of millions of barrels of oil, trillions of cubic feet of gas every single day for decades to come. It's a long, gentle slope down, not a sudden drop.
Gives established players a long runway.
A very long runway. And then, of course, you have the company's own view. ExxonMobil's outlook aligns more with the EIA.
They see longer demand.
They forecast oil and gas still meeting over 50% of the world's energy needs in 2050. They really emphasize the demand that's hard to get rid of: heavy transport like trucking, shipping, aviation, and the demand for petrochemical feedstocks, which is growing. Things that are very difficult to replace with renewables at scale today.
So if you synthesize these views, EIA, IEA, the company itself, the picture seems to be demand stays huge for a long time.
That's the key takeaway. Peak oil demand doesn't mean demand disappears overnight. It likely means a peak, followed by a long, high plateau, and then a slow, managed decline over many decades. Low-cost producers can make a lot of money during that time.
Which brings us to a fascinating way to think about risk: inversion. Instead of asking how this succeeds, ask, what would have to be true for this investment to fail catastrophically?
Exactly. It's a powerful mental model. So imagine it's, say, 2030 or 2035, and the investment in ExxonMobil has been a disaster. What must have happened?
What unlikely combination of events could cause that?
Well, you'd need several highly improbable things to occur, probably all at once. First, you'd need draconian global policy coordination. Meaning unprecedented agreement among all major economies, US, China, India, Europe, to implement incredibly strict, rapidly escalating carbon taxes or caps that make fossil fuels prohibitively expensive, like tomorrow. The kind of global alignment needed for that, well, it's never happened before on this scale.
Okay, unlikely policy coordination. What else?
Second, you'd need sudden technological miracles.
Like discovering warp drive.
Maybe not quite that dramatic, but close. You'd need immediate, commercially viable breakthroughs. Batteries that make electric trucks cheaper than diesel now. Green hydrogen that's cost competitive now. Sustainable aviation fuel at scale now. Not gradual improvements, but instant game changers across multiple fronts.
Also sounds improbable.
Very. And third, you'd need a radical shift in global consumer behavior.
How so?
Primarily in the developing world, where energy demand is growing fastest. Billions of people there would have to collectively decide not to use affordable, reliable hydrocarbons to improve their living standards, choosing much more expensive, less reliable alternatives instead, voluntarily.
So drastic policy, tech miracles, and a collective global decision to forego cheap energy, all happening fast and together.
The probability seems exceptionally low, which strongly suggests the transition will be a multi-decade affair, giving companies like ExxonMobil plenty of time to profit from legacy assets while building new ones.
And this cautious, reality-based view helps explain why their strategy looks different from some peers, right? Like Shell.
Yeah, it does. Shell, for example, went big into integrated power, investing heavily in renewable generation.
But they've pulled back a bit recently.
They have. They've moderated some aggressive 2035 decarbonization targets, shifted focus within their power business. It suggests that maybe the returns in renewable power generation weren't quite what they hoped for, and the core oil and gas profits are still absolutely essential to fund everything. Value over volume seems critical.
And Chevron.
Chevron's strategy looks more similar to ExxonMobil's. Strong focus on advantaged oil and gas, capital discipline, shareholder returns. Though maybe Chevron has been a bit more public about specific new energy ventures like renewable diesel or lithium.
So comparing them really highlights ExxonMobil's focus.
It really does. Their deliberate focus on their core competence, their refusal to dilute returns just to chase trends. It's a pragmatic, return-driven approach.
Okay, so a strong business model, a widening moat,
Mm-hmm.
but a great company can still be sunk by bad management. How does ExxonMobil's leadership stack up under CEO Darren Woods? What's their mindset?
I'd describe their philosophy as deeply pragmatic. It's grounded in engineering reality, and it's economically rational above all else.
Pragmatic, how?
Well, Woods consistently talks about a balanced, practical energy transition. Crucially, he frames the challenge as eliminating emissions, not eliminating oil and gas itself.
That's a key distinction.
It is, because it opens the door to solutions like carbon capture, hydrogen things where they do have core competencies. He insists policy needs to be based on science and business facts, not ideology, and must prioritize energy affordability and reliability alongside climate goals.
And they seem laser-focused on shareholder returns.
Unyieldingly so. Management is very explicit. They will not invest shareholder money in projects that don't meet tough return thresholds. Woods has flat out said they won't invest in wind and solar generation because they don't see above-average returns for investors there.
That's pretty blunt.
It is. He said their goal is to cater to real investors who want the company to succeed in generating returns, not just appease activists with low-return projects. That's the language of a fiduciary, totally focused on economic value for the owners.
There's also a sense of intellectual honesty, even if it's uncomfortable.
Yes, I agree. Woods is notably candid about how huge, complex, and expensive the energy transition really is. He keeps saying society needs a market mechanism, like a carbon price, to pay for reducing emissions.
Basically saying someone has to pay for it.
Right, arguing that people who are generating those emissions need to be aware of and pay the price. It draws criticism, sure, but it's an honest assessment of the economic reality decarbonization isn't free. For long-term investors, that kind of candor is much better than wishful thinking.
Okay, pragmatic mindset, focus on returns, intellectual honesty.
Mm.
How does that translate into managing the money? What does the capital allocation scorecard look like? Talk is cheap, right?
Performance is everything, and their record, especially recently, has been quite exemplary. First, look at capital discipline.
They tightened the reins.
Significantly. After some criticism for high spending a few years back, they've put in place rigorous discipline. Annual capital spending is now tightly controlled, $22 to $27 billion range through 2027.
And where is that money going?
Critically, it's going only to the highest return projects. They project over 90% of their new upstream investments will deliver returns over 10%, even if Brent crude drops to $35 a barrel.
$35 again. That shows the quality of the assets they're investing in.
It absolutely does. It reflects that high-grading strategy and their discipline.
And big strategic moves. The Pioneer acquisition was huge. Was it disciplined?
The value-accretive acquisition of Pioneer, yes. It was a $63 billion all-stock deal. Seems like it was done at a reasonable price, and the strategic fit is perfect.
Cementing their Permian leadership.
Exactly. And they've already upped the expected annual synergies from the deal by over 50%, now targeting more than $3 billion. That suggests they're good at integrating these things successfully. It wasn't just about getting bigger, it was about getting better in their core strength area.
And then, critically important for many investors, returning capital to owners.
A top priority for them, clearly not an afterthought. Two main ways. First, the dividend.
They have a long streak, right?
Pure leading. 41 consecutive years of dividend increases, and they kept that streak alive even through the chaos of 2020. That says a lot about commitment and financial strength.
And a second way.
Share repurchases. Huge buybacks. They did $17.4 billion in 2023, and now they're running at a pace of $20 billion a year through 2025.
Wow, $20 billion a year just on buybacks.
It's one of the biggest programs globally. It's tax efficient for shareholders, and if management believes the stock is undervalued, it significantly boosts the per-share value for everyone who stays invested long-term.
It's interesting, too, how that proxy fight back in 2021 with engine number one, it didn't force a U-turn, did it? It seemed to actually sharpen their existing strategy.
That's a really insightful observation. It acted as a catalyst. Management doubled down on cost cuts, doubled down on high-grading the portfolio. They essentially executed their existing plan more aggressively.
And the results?
Speak for themselves, really. Since that proxy fight, ExxonMobil's total shareholder returns have led the industry. Cash flow is way up, balance sheet is stronger, and look at the 2025 annual meeting. Shareholders overwhelmingly backed the incumbent directors, rejected all activist proposals. It's a powerful endorsement of the current strategy and performance.
So if we use that Buffett framework again for evaluating management, do they resist the institutional imperative, mindless imitation?
Clearly, yes. They've resisted immense pressure to follow peers into low-return renewables, sticking to their own competence-based strategy.
Are they candid?
I'd say yes. Wood's communications are direct. He doesn't sugarcoat the challenges or trade-offs in the energy world.
And do they think like owners?
The intense focus on return on capital, the discipline on spending, the huge buybacks, those are all strong signs of an ownership mindset. They seem to be allocating capital like prudent owners of the whole business, not just managers growing an empire.
But maybe the most striking thing, the detail that really drives home management alignment, is their compensation structure. That seems unique.
It really is almost unheard of. It forces an incredibly long-term perspective.
Explain that again, the vesting period.
Okay, so for senior executives, the performance-based stock awards, which are the bulk of their pay vest in 2 stages, 50% after 5 years.
Right.
But the other 50% vests after 10 years or at retirement, whichever is later.
Whichever is later. So even after they retire.
Yes. They have to live with the consequences of their big decisions for a full decade or more, even after they've left the company. A bad decision made today for short-term gain will hit their own net worth 10 years down the road.
That is profound alignment. It forces true long-term thinking.
Absolutely. Plus, the performance metrics for those awards aren't just financial. They include safety, reliability, return on capital, and specific goals for reducing emissions intensity and leading in the transition. And on top of that, significant insider ownership. The CEO holds over $33 million in stock. Real skin in the game.
Okay, qualitative strengths look good, management alignment seems exceptional, but it has to show up in the numbers. What do the financials tell us about ExxonMobil's strength?
Well, if you look back over the last decade, you see that cyclicality, definitely. Revenue and net income swing wildly with commodity prices.
Like 2020 versus 2022.
Exactly. A $22.4 billion net loss in 2020 during the pandemic depths. Then, just 2 years later, a record $55.7 billion net income as prices surged. It really highlights the inherent volatility.
But if you look through that cycle, what's the metric that really shows the underlying health, the core strength?
I'd say cash flow from operations. That figure has stayed strong and grown significantly. It hit a massive $76.8 billion in 2022, still very strong at $55.4 billion in 2023.
And that shows.
It shows the core business just churning out cash, regardless of non-cash accounting charges like write-downs that can hit net income in bad years. And the balance sheet reflects this too.
They paid down debt.
Aggressively. They took on debt in 2020 to protect the dividend and essential spending, but then used the cash gusher afterwards to pay it down rapidly. The balance sheet is back to being a fortress.
Okay, let's put some numbers on that quality. Key performance indicators. Return on invested capital, ROIC.
Also cyclical, but exceptionally strong recently, averaged over 15% in 22 and 23. That directly reflects the focus on high-return, low-cost projects. It's designed to keep ROIC strong through the cycle.
And the lifeblood, free cash flow,
It's
FCF.
prodigious amounts. $36.1 billion in 2023, $35.7 billion in 2024. Just massive. And it's this huge surplus cash after all spending is done that lets them pay the big dividend, do the huge buybacks, and keep the balance sheet strong all at the same time. It fuels everything.
Which leads to balance sheet fortitude. How strong is it?
It's a key differentiator. Debt-to-equity ratio was up around 46% in 2020, now down to a very conservative 18.3% as of early 24.
That's a big drop.
Huge. And maybe more importantly, that debt is incredibly well covered. Operating cash flow covers total debt by over 147%. That gives them immense financial flexibility.
So this financial strength, it creates that margin of safety that value investors talk about. What does that mean in practice for ExxonMobil?
It's more than just defense. It's a strategic weapon. It means they can genuinely operate with a long-term view. They can withstand a nasty, prolonged industry downturn without facing an existential crisis.
And they can invest when others can't.
Exactly. They can be counter-cyclical, keep investing in their best projects, maybe even make smart acquisitions when competitors are weak and forced to sell assets cheap or cut back drastically. And for investors, it's the bedrock supporting that reliable, growing dividend. This financial strength is a defining feature of a wonderful company built to endure.
Okay, but no investment is risk-free. To be intellectually honest, we have to stare the risks in the face. Let's do that pre-mortem. If this investment fails looking back, what would have caused it?
A crucial exercise. And there are significant risks. First, the obvious one, commodity price volatility.
Oil and gas prices.
Right. Their earnings are directly tied to global prices. A long slump due to recession or oversupply would absolutely hurt their results. Their low costs help, but nobody is totally immune if prices crash and store down.
And operating globally must bring risks.
Huge geopolitical and regulatory risk. They operate everywhere, including some pretty unstable places. Risks of expropriation, contracts being torn up, civil unrest. It's always there.
And closer to home.
Domestically, significant regulatory risk, new environmental rules, maybe price controls, talks of windfall profit taxes. All that could increase costs or cut into profits significantly.
They also take on massive projects. Execution risk must be a factor.
Absolutely. Guyana, integrating Pioneer, building those big LCS facilities. These are incredibly complex, multi-billion-dollar undertakings. Delays, cost overruns, major accidents. Any of those could hurt returns and damage their reputation. These aren't easy projects.
But the big one, the long-term elephant in the room, remains the pace of the energy transition.
That's the paramount long-term risk, no question. The whole investment case rests on this transition taking decades, with hydrocarbon demand staying strong for a long time.
And if it happens much faster.
If some combination of tech breakthroughs and aggressive global climate policy makes oil and gas demand fall off a cliff much faster than expected, then they could face stranded assets, huge write-downs, erosion of their core earnings power. That's the scenario that would fundamentally impair the long-term value. It's the big what if.
Okay, those are the risks. But what about the upside? What could go right and maybe accelerate value creation? Potential positive catalysts.
Definitely some strong possibilities there, too. First, technological breakthroughs from them.
Within their own R&D?
Yes. Imagine if they crack the code on dramatically cheaper carbon capture, or affordable biofuels from algae, or efficient direct air capture of CO2. If they develop and scale technologies like that, they could lead industries worth trillions in a decarbonizing world. Given their R&D history, it's not impossible.
What about the wider industry? Could dynamics there help them?
Yes, potentially structural industry underinvestment. If ESG pressures and policy uncertainty cause the whole industry to underinvest in new oil and gas supply.
Which seems plausible.
Right. And remember, existing fields decline naturally, maybe 5–7% a year. If supply doesn't keep up with even plateauing demand, you could get a structural supply-demand imbalance.
Leading to?
Leading to potentially years of high, elevated commodity prices. And who benefits most in that scenario? The disciplined, low-cost producers with available projects like ExxonMobil, they could reap windfall profits while others scramble.
Okay, and the third catalyst, you mentioned LCS value?
Exactly. The market re-rating of low-carbon solutions. Right now, the market gives that segment very little, if any, value. It's seen mostly as a cost center, a future bet.
But if it starts delivering?
As LCS signs more real, long-term commercial contracts for things like carbon storage or hydrogen supply, as it starts showing a clear path to profits and material earnings, that could trigger a big shift in perception. The market might suddenly assign a significant value to it, leading to a re-rating of the entire company's valuation multiple. That's a potentially large source of unlocked value.
Okay, so pulling all these threads together, the business, the moat, the management, the financials, the risks, the potential catalysts, what's the final verdict? Does ExxonMobil clear the bar for being a wonderful company for a long-term investor?
Based on the evidence we've examined, I think the answer is yes. It strongly suggests it does. The quality of the business is exceptional, and it seems to be improving, driven by that integrated model and the streamlined structure.
And the moat.
The moat is wide, deep, and arguably widening, built on that unbeatable scale, those advantaged low-cost assets, and that deep proprietary technology.
And the people running it.
Guided by a rational, disciplined, and I'd argue, uniquely shareholder-focused management team. Their pragmatism, their focus on returns, their commitment to returning cash, it's all there.
Yeah.
And that compensation structure really seals the deal on alignment with long-term owners.
Financially sound.
Like a fortress. The balance sheet is strong, cash flow generation is immense. That provides a huge margin of safety and lets them execute their strategy confidently through thick and thin.
But the energy transition still looms large. Does that disqualify it?
It's the key risk, no doubt. But their strategy addresses it directly. Focusing on the lowest cost assets means the core business should stay very profitable for decades, even under most credible transition scenarios. They're positioned to be the last ones standing. And the disciplined way they're building LCS ensures they stay relevant, extending their skills into the future energy system. They're adapting strategically, not just digging their heels.
So wrapping it up, what does this mean for you, the listener, maybe thinking about this as a potential long-term holding?
Well, ExxonMobil seems to tick the boxes for what defines a wonderful company. Durable competitive advantages, check. Essential products society needs, check. Honest, capable management thinking like owners with skin in the game, check.
And the valuation.
At the current valuation, around 6.6 times EV/EBITDA. That doesn't seem demanding for this level of quality. It's pretty much in line with historical levels. And consensus analyst targets suggest maybe 17% upside even before you factor in the dividend, which is substantial and growing.
So the market might be underappreciating it.
It appears the market might be underappreciating the durability of demand, the strength of their advantages, and just how much value they're consistently generating and returning to shareholders right now. For a patient, business-focused investor with a truly long-term horizon, well, It looks like a compelling opportunity today.
That has been a really thorough deep dive into ExxonMobil. We've definitely peeled back the layers. It's not just an oil giant. It's this complex, strategically shifting entity with deep advantages and a management team really playing the long game.
It really does highlight how crucial it is to look past the simple headlines, dig into the nuances of an industry, understand the competitive dynamics. Sometimes you find surprising opportunities and real long-term value where others just see yesterday's news.
So as you, our listener, reflect on all this, here's maybe a provocative thought to leave you with. In a world obsessed with disruption, what's the real long-term value of a company that excels not just at enduring, but at strategically adapting its core strengths within an absolutely essential industry, rather than chasing every shiny new object? What stands out to you about ExxonMobil's path forward in the future of energy? Thank you so much for joining us on this deep dive. We hope it gave you plenty to think about. Until next time, keep digging into the details.